Hello everyone, thanks for checking out my video. The S&P 500 and technology-heavy Nasdaq just had the worst weekly performance since March this year. Not just that, they are currently on the losing streak with a third straight negative week and fourth straight day of losses. And according to Bank of America, investors are dumping stocks at the fastest pace since December last year, as the Federal Reserve's higher for longer interest rates approach increases the risk of a recession. Meanwhile, the bond yields are popping to a highest level since 2007, which is a threat to the stock market. It is quite evident by now that the bearish September is taking its effect. So here's the question, what caused this? And is this a start of something more serious? More importantly, there is one very important potentially market-moving event this week. And for option traders, I have a lot to share in this video with regard to my option trades, so do watch on to find out more. The stock market was struggling throughout the entire last week as investors were digesting, considering, positioning, or whatever you want to call it for a higher for longer interest rate environment. Something that Jerome Powell has previously mentioned and was emphasized again during last week's FOMC press conference. Some are saying Powell's speech was more hawkish than expected, but I actually beg to differ. In my view, Powell was repeating the same stuff that he has been saying for the last, half a year, such as higher for longer, possibility of one more rate hike, proceed carefully, data dependent, rate cut won't come so soon, etc. etc. Not just this, the Fed had also decided to hold the interest rates, aka a pause, which has been widely anticipated by the market. So where's the surprise? But the market still decided to sell off last week nonetheless. I mean, if we really want to put a reason to the sell off, I would think it's the expected rate cut next year. Projections released in the Fed's dot plot showed a likelihood of one more increase this year, then 2 rate cuts in 2024, 2 fewer than what were indicated during the last update in June. In addition, the projection for the Fed funds rate also moved higher for 2025, with the medium outlook at 3.9% compared with 3.4% previously. Can you imagine this kind of high interest rate environment continuing into 2025? Will be interesting to watch how the various growth stocks move. Anyway, that was for last week, which pretty much revolved around Powell's speech and digesting the content. For this week, we have 2 very important events to watch. The first one is the release of the PCE inflation data on 29 September, Friday. The latest spike in oil prices is causing some headaches for the Federal Reserve as energy costs are on the rise again. On top of this, strong personal spending and income do worry the central bank too, as they could potentially drive up inflation. So, just when the Fed is starting to see the result of their hard-fought battle to get inflation down, any upside surprise in either or both personal consumption and core PCE inflation data will mean a second inflation wave could be on the card, and the odds of another rate hike is even higher. Also, just to highlight, this Friday is the last trading day of the month and quarter, and there could be institutions maybe doing some rebalancing work for their portfolios, and therefore that day could be really volatile. Technical wise, the market could be due for a bounce after 3 days of sell-off, so if we were to have a rebound early this week, I wouldn't be too excited yet because the market moving events are towards the end of the week. So, other than the PCE inflation data, the other event to watch is a looming US government shutdown, and this could really rattle the stock market. Time is running out for the US lawmakers to strike a deal on their spending bill before the critical midnight deadline on 30th September. Well, for the benefit of viewers who don't know what this means, basically, the government funding will expire at the end of the day on 30th September when the clock strikes midnight and it becomes 1st October, which marks the start of the new fiscal year. Therefore, if Congress fails to pass the legislation to renew funding by the deadline, the Federal Reserve government will shut down at midnight. This would then mean the US government services and potentially the economy would be disrupted and hundreds of thousands of federal workers will not get paid. Since that would take place over the weekend, the full effects of a shutdown wouldn't be seen until the start of the work week on Monday. But of course, government operations and services that are deemed essential will continue to operate. but they would not be paid during the shutdown. For those roles that are deemed non-essential, they would not work and would not receive pay as well. And in case you think this will not happen and it is just a scare tactic, well, just so you know, it actually happened quite a number of times over the years. And the last shutdown was in fact the longest in history, from midnight of 22nd December 2018 till 25th January 2019, a total of 35 days. When such thing happens, investors' confidence would quite sure be shaken as the shutdown would potentially affect fourth quarter GDP. Okay, moving over to the technical analysis segment. So in my last video, I shared that if SPY breaks below 439, I will be quite careful because the next target will likely be the 100 moving average at 433. And as you can see, SPY really hit 433 and closed last week at 430. For this week, or maybe even till next week, there are two key levels to watch. If both of them get breached, I would say that the overall market trend is very bearish. First of all, can you see this uptrend channel marked by the green dotted trend line? I think I have shared before that we should not be surprised if SPY starts testing the bottom of the channel, which it is currently doing so. Therefore, together with this green dotted line that marks the bottom end of the channel, watch out for 426, which is the 38.2 Fibonacci retracement level. SPY can break below the green dotted line a little bit, it's fine, but 426 has to hold. Okay, if it doesn't hold, then here comes the second key level or area to watch, which is around 415 to 417. In fact, this is the more critical zone to watch than the earlier one. Why so? Firstly, this is where the next Fibonacci support level lies. Secondly, that is where the blue dotted downtrend channel is. Thirdly, and more importantly, this is where the 200 moving average sits, at around 415. So if this area gets breached, then the entire stock market is likely facing a bloodbath. In terms of the bullish thesis, if SPY can touch that green dotted uptrend channel line and bounce, it is bullish. But remember, I shared that market makers don't set things up so nicely for retail investors. So SPY may breach that line a little bit to shake out or scare paper hand investors before bouncing up. In fact, this happened in March this year, where SPY broke the uptrend channel for a few days and bounced back up, and then went for a monster rally. So watch this green dotted line carefully, okay? Okay, here's one small good news for the bulls, which is whenever RSI hit the oversold level, we tend to have a bounce. As you can see from the chart, the recent one was just last month in August. And to write on to that, it happened a few other times over the last 1 year. But yeah, here's the caveat, whether the bounce is sustainable or not, it's questionable. So short-term traders may consider playing this bounce and exit when it shows signs of falling back. Not financial advice, okay? Alright, let's now check out Apple's chart. Since Apple had the gap down, it has been consolidating for the last 12 trading days, in a range between 173 and 180. For Apple to be bullish, it obviously has to break out of this consolidation zone. Ideally, Apple has to fill the gap between 180 to 181 and then close above the 38.2 Fibonacci level at around 182. For Apple to really regain the bullish momentum, then it has to reclaim the 50 moving average, which currently sits at 183. But to be honest, I think we can expect heavy resistance at the gap area, because that is where the Ichimoku cloud is at the moment. To clarify, I am not saying it will definitely get rejected, but just have to be mindful or be aware that sellers may step in at around 180 to 181 area. So if let's say Apple really gets rejected, again, the recent low of around 172 will act as a support. But if this support level breaks, I think bulls have to be very careful, because breaking below 172 gives us a high chance to fill the gap between 166 to 170. Below this gap lies a critical support area, which is formed by the red dotted downtrend line and the 200 moving average. I would say it's around 164 to 165, and if Apple falls below this area, we can expect the overall market to be bearish as well. Interestingly, at the very moment, it seems like bulls are protecting the recent low of 172 because we have about 6 candlesticks going near to that level but did not test it. So how long will this last? We will not know. All I know is if bulls lose this area or level, we can expect a bit of sell-off. Moving over to Tesla. So last Thursday, when the market opened for about 10 minutes, I quickly posted the following post, which is on Tesla's bearish signs. So right now, I will use the chart to explain to you. First of all, it's the bearish RSI divergence. Second, it is the gap down below the key 61.8 Fibonacci level and the long-term red dotted downtrend line. Thirdly, the MACD was about to have a bearish cross on Thursday, and it was later on confirmed on Friday. And so on Friday, Tesla fell 4%. In fact, last week I also shared that if 263 to 266 breaks, we will almost certainly head towards 256 to 260, and it all happened. In fact, Tesla went even lower. So guys, if any of this technical analysis has benefited you, I would really appreciate if you could help to hit the like and subscribe buttons as I continue to churn out all this content for free. The like and subscribe buttons are free as well. I am less than 100 subscribers away to hit my 1000 mark. Collectively, I believe we can hit it very soon, and hopefully this video can garner more likes as well. Anyway, going back to Tesla, I think even one doesn't know technical analysis, one can still tell that Tesla is bearish with 5 red candles in the last 6 trading days. Technical wise, it has broken multiple support levels in just 1 week. Right now, it is sitting near a support level of 245. Come this week, Tesla needs to reclaim this 245 level quickly if bulls want to gain back control. Ideally, bulls need to bring Tesla back up above the resistance level of 255 and fill that gap down, which is between 260 to 262. If Tesla can close back above these levels, again recap 245, 255 and around 260 to 262, then we can say that the short-term downtrend has reversed. On the other hand, if Tesla cannot reclaim even the first level of 245, then watch for 238. I'm sorry if it looks a little messy on the chart, but can you see that blue 61.8 Fibonacci retracement level? This level needs to hold. I repeat, this level needs to hold. Why so? Because 61.8 Fibonacci level is usually deemed as a critical level to cross, and also this level is where the current 100 moving average sits, therefore forming a double support. And the not so good news is that 244 to 238 is just a 6 points drop, which is nothing to Tesla. It could really hit it anytime. So basically, I will watch this level closely early this week, before the market moving events towards the end of the week. And if this double support of 238 cannot hold, Tesla could easily waterfall to 230 and below. Just to share, below 230, I don't see a lot of support. So I think the gap between 217 to 220 will naturally come into picture. Anyway, all those bearish signals that I shared are the reasons why I didn't sell cash secured puts options on Tesla last week, because the chance of Tesla falling was quite high. But since Tesla has already fallen so much throughout the entire of last week, I am looking for reversal or so-called bullish signals now, as well as opportunity to sell puts, especially since it has already plunged so much. Okay, moving over to Google. You know they say trend is your friend until it bends. So for Google, I would say the trend has bended a little. Remember, I have been sharing that so long as Google stays above 133 to 134, we have a chance to fill the gap between 139 to 140. Well, Google went up to 139.16 but didn't manage to fill the entire gap, got rejected, and with a blink of an eye, they are back at 130. That's bearish, because they have fallen below the important 133 to 134 level that I have been talking about. However, the saving grace is that it is currently sitting at a support level of 130, which is formed by both the 50 moving average and the 38.2 Fibonacci retracement level. But in a way, this makes it a double-edged sword actually, because if Google breaks below 130, it is breaking two support levels at the same time. Anyway, if you have been following me and if you could recall, I have shared about this consolidation zone that Google was once in between 127 to 133, so not all hope is lost for the bulls yet. Bulls should only be worried if Google breaks below this consolidation area, meaning to say go below 127. Coincidentally, 127 itself is a support level, therefore breaking below it, Google is breaking another double support level. So you got it, 130 and 127 are both double support, and if they get breached, the big gap you see on the chart is calling for Google to go down. In terms of the upside, it's quite straightforward. Google has to reclaim the important 133 to 134 levels, and then bulls will try to push it towards 139 to 140 gap again. Anything below 133, I would say Google is looking a little bearish in the short term. But that being said, I actually saw a cash secure put on Google last week, which is a slightly bullish move. Am I contradicting myself? Well, let's now move over to the technical analysis segment as I explain why I made this trade. Okay, the short and simple reason why I sell cash secure put on Google is I try to front run the market. But if you are keen on my detailed thought process, could you please help to tap the like button please? Let's try to get 40 likes for this video. Anyway, the cash secure put that I sold on Google was with a strike price of 120 expiring 27 October. There are a few reasons why I make this trade on Thursday 21st September. Firstly, the stock has fallen quite a fair bit for 2 consecutive days, about 5.6%. That's quite rare for Google. The decline has brought Google into an oversold level on the RSI. The next reason is because there is a double support level at 130, which I have shared earlier in the technical analysis segment. Not saying this will not get breached, but it does have some probability of finding support here. On top of this, Google has also hit the bottom of the Bollinger Band, which then gives it some probability of bouncing. In terms of the strike price, I tried to play it safe by choosing a strike price that's below the 61.8 Fibonacci level. And oh, the strike price of 120 itself is a support level. So when you combine all these bearish signals that had already happened, my take is a short-term bounce or a sideways movement could be on the card for Google, and when that happens, my trade will profit. Alright, the next trade that I opened last week was a cash secure put on Microsoft with a strike price of 300 expiring 27 October. This is actually a risky trade, so let me explain why is it so and how I manage the risk. Okay, so why is it risky? First of all, I opened this trade a few hours right before Powell's speech. This itself is risky because the market could swing wildly in either direction after the meeting. If it plunges, then my trade will be in the red, which is happening right now. But I wouldn't say it is a surprise as I am already aware of this risk. Second reason why this trade is risky because technical wise, MACD just had a bearish cross, and it could fall further, so selling a put at that point was, yes, risky. So then why do I still make this trade? Well, one main reason is because I had a few contracts expired previously, so I want to open a trade to keep my monthly passive income from options trading coming in. And as the market could go either way post FOMC meeting, I was thinking, what if the market rallies hard? Then I may be forced to sell a put with higher strike price because a lower strike price would have given me lesser premium when the market goes up. Therefore, to manage my risk, first of all, I went small by only choosing one stock and one contract. I mean, I was looking at Tesla, Apple and Microsoft all at the same time. Among them, Tesla is the most volatile and looks the most bearish, so I avoided selling it before Powell's speech, which I think it was a right decision. And then, among three of them, Microsoft was the most oversold on the RSI on that day, giving it higher chance than the other two to bounce in the near term. Lastly, I chose a relatively safe strike price, at least in my opinion. As you can see, when Microsoft declined recently, it only dropped to 311, which is above my strike price. And the last time the stock was at my strike price was in April this year, which was 4 months ago. Therefore, for Microsoft to reach that level, it means the broader market has to be quite weak. Alright, the last trade that I opened this week is this cash secure put on Bank of America with a strike price of $26. Let's talk about the risk first. First of all, Bank of America has broken below the blue dotted uptrend line. Secondly, MACD just turned bearish. These two signs mean that there is a risk that Bank of America may fall further. Okay, so why did I still make this slightly bullish trade? Well, first of all, I have some Bank of America shares with a cost price that is above $30. So if I get a side with $26 strike price, I can lower my average price and make it easier for me to sell covered calls. Secondly, Bank of America has fallen out of the bottom of Bollinger Band. Next, we have seen 6 red candlesticks in a row and RSI has dropped to an oversold level. All this gives the stock some chance of bouncing up or going sideways for a short while. Finally, we have a decent support line marked by that green dotted line, and that level is $27. So I chose a strike price that is below it at $26. In addition, the last time Bank of America closed below $26 was in November 2020. Therefore, in my view, the chance of my strike price getting breached is relatively low, although not impossible. Okay, I know this video is getting longer, in fact the longest. But if you appreciate my effort in putting out all this free content, please do help to hit the like and subscribe buttons. Anyway, very quickly, I have one cash secure put on Google with a strike price of 118 expiring this Friday 29 September. So if Google doesn't fall below 118 on Friday, the contract will expire worthless and I get to keep the full premium. I have shared the rationale behind this trade before this, and if you do not want to miss my updates, do stay subscribed to my channel. Alright, some quick end thoughts for this video. It has been a sluggish, volatile and stormy September. I have shared on the moomoo app that I think investors are pricing in a rate cut too soon and overly optimistic. And it is about time for them to be concerned or wake up to realize that inflation and the path of the Federal Reserve rate hike campaign continue to pose a threat to the stock market. What didn't help the stock market, or rather what had helped the investors to wake up, is Powell's reiteration that rates are not going down anytime soon, and it will likely drag on for very long. Also, the recent rally in oil prices is adding further pressure to inflation and the Federal Reserve. Well, as a result of the recent events, we have analysts or so-called experts start bringing back the narrative of persistently high interest rates could lead to a hard economic landing or recession in 2024. To add even more pressure to the stock market, bond yields continue to rise higher following the higher rates for longer message by Jerome Powell. The 10-year Treasury note yield rose to a fresh high of 4.445% last Thursday, the highest since 31st October 2007. And what does this translate to? In very simple terms, high treasury yields make investments in your high growth tech stocks like Nvidia, Tesla, Palantir and whatnot less attractive, because these treasuries are deemed safer than stocks as they are backed by the US government. Okay, in case you think I'm all bearish again, nah, not quite yet, until the technical charts show me so. My thoughts are, the recent reaction or sell-off might have been overdone. As shared in my last video, a hawkish pause by Jerome Powell and team is expected, and I think the market has overly reacted to it. Just to add on, since end July, I have talked about how August and September have been traditionally bearish and investors or traders have to proceed with caution even when we are in a bull market. And guess what? Statistics don't lie, and the stock market has been relatively weak for the last 2 months or so. But does it worry me? Again, not quite yet. In fact, as you can see from my option trading segment, I have opened a few slight bullish trades, something that I have shared in a few videos too, which is to sell cash secured puts in a bearish September month in anticipation of a potential recovery in October or November. But of course, I could be wrong. If I am wrong, I will roll my option trades, and at the same time, I will pick up more shares for my long-term portfolio if the market continues to fall further. I mean, at the end of the day, remember this: don't spend too much time to try to guess where the market is going. A role of a long-term investor is to be ready to unload your cash when the market falls. So, have you been trading or buying stocks in August and September? Let me know in the comment section below. Meanwhile, do help me beat the YouTube algorithm by hitting the like and subscribe buttons. Thank you.